it's foremost, it's really great to see people in a room and be with them in a room. We've been doing this virtually for 2 years, and then, you know, actually after last year, then we had discussions and how we would do this year's annual meeting, and there were actually quite a few voices that said, oh, these virtual formats are so good. Those came actually from people who had to travel very far. But then people, you know, adamantly insisted that we not only should do an in-person event, right, because you really miss these kind of side interactions in the virtual world, but also that we should really not even go for a hybrid format, but really stream only a few sessions, and we'll put a few sessions that are marked on the program on YouTube, but the rest is really just for those who are present here, and it's really great to see so many faces. I want to start just with saying 2 things. First, keep in mind, right, this is a research event. We have a lot of policymakers, a lot of people from policy institutions, but we all speak on our own behalf. Just a general disclaimer for the event. That's also multiple times in the program, but I want to repeat it here. And second, I want to thank a number of people that made this event possible. So first and foremost, I want to thank the steering committee. We have Eva Ortega from the Banco de España here. We have Alberto Martín from Pompeu and Barcelona School of Economics, and Rafael Schönle. And I want to thank those 3, in addition to Carlos Thomas from Banco de España, and Luca Gambetti from BSE, and Loriana Pellinson from the Research Institute SAFE for forming the steering committee and bringing this event to the ground. So thanks a lot. I also want to thank Jordi Galí, for putting together an excellent panel that we will kick off in just a few minutes. I want to thank the organizing institutions, which are the Banco de España, the Research Center SAFE in Frankfurt, and the Barcelona School of Economics, together with the organizing team from the Department of Economics and Business at the Universitat Pompeu Fabra. Thank you very much. And in particular here, we want to thank Bruno Guala and Ana Ventura for the organization. Thanks. I'm not sure where you are. So yeah, I want to conclude here. I really want to focus on thanking Rafael Schönle, who's I've recently changed job at the BS, and I had to sort of reduce my engagement for this annual meeting a bit, and Rafael Schönle really took over and played a major role in this event, so I want to thank him again. And also, for Rafael and for our host organization, all want to say some words, and I leave you with that. Thank you.
Well, you know, I will not be able to add very much to Rafael's gracious thank you for everybody. But maybe one thing, that selecting the papers was really exciting. It's a very interesting time to be an economist and central banker at the same time. So, you know, my additional thanks really go to you, who make this really interesting and possible in the first place. And I look forward to the future meetings, which I think will be hopefully a little bit less interesting topic-wise, but still very exciting.
Okay, good afternoon, welcome. I am here to welcome you on behalf of the Barcelona School of Economics. We are very pleased to host this event of an annual meeting of CEBRA, co-organized by SAFE and Banco de España. And well, we hope you feel welcome here at the BSc and more broadly in Barcelona. For those of you that came early yesterday, we organized a very nice soccer exhibition at Camp Nou, so I hope you were able to see that. We have great papers, great panels, so it's a great way to end the summer holiday. Hopefully we'll all go back to our desks full of energy and ideas to write better papers. And let me just conclude by thanking our organizing staff and some of our graduate students who have really put in a lot of work to get this smoothly off the ground. So thank you to them, and welcome to the rest of you, and have a great conference. Thank you.
Finally, just to kickstart the panel, a warm welcome from the Banco de España behalf.
Okay, well, good afternoon, everyone. My name is Jordi Galí, and I will be chairing this policy panel. We're very fortunate to have three distinguished panelists this afternoon. So, Martin Flodén, who's Deputy Governor at the Riksbank, Diogo Guillen, who is the Vice Chairman of Economic Policy at the Central Bank of Brazil, and Philip Lane, who's a member of the Executive Board at the ECB. Okay, so there are three central banks working in three economies that pretty much span almost all the universe of economies in several dimensions. So let me just briefly remind everyone about the format of this. So we'll start with a 10-minute presentation from each of our panelists, in which they will give their perspective on the current challenges facing monetary policy, which are not few or small. And with a special focus, I asked them to give a special focus on the challenges in their own jurisdictions. And then we'll take maybe a couple of minutes and we'll give them a chance to comment and pick up on each other's presentation or remarks. And finally, we'll try to allocate the second half of this session to give the floor to the audience and to give you all a chance to ask questions to our panelists. So why don't we get started, and Martin Flodén will be the first to present. Please, Martin, go ahead.
Thank you very much, and thanks in particular for having me here. I'm very happy to be here in this conference. I've never participated in the conference before, but it looks like a great conference for a central banker like me. So Jordi, as he said, he asked us to talk about challenges for monetary policy that we currently see. And I actually prepared a few slides, but I will not cover all the challenges that we are currently facing, and there are plenty of them. And they are very similar, I would say, also throughout the different countries. And obviously, we all struggle with problematically high inflation currently. But the two topics that I want to mention today, I chose them because I think this is a very nice audience, I hope, to discuss these two topics. The first is about how quickly should we adjust our policy rates when there are news about the economic developments, and in particular when there are news about inflation dynamics as we are seeing it today. As you probably know, most central banks typically respond gradually. And today we say we are in a hurry, we should front load our adjustments, etc. But the approach is still gradual. I'll show a few slides on this. The other topic that I want to mention is about financial independence of central banks. How should central banks be funded, and do we have problems with the funding models that we are seeing today? Will central banks remain independent, financially independent in the future? And I chose those topics because I think that they are high on the policy agenda, at least in Sweden today. Not the top questions. Obviously, the immediate inflation problem is the top priority. But those are things that we do discuss. But I think in the research literature, I haven't really seen much attention to these two questions recently, and I think those are great topics for us to discuss together here, but maybe for some of you to also think about more deeply in the years to come. So let me start with the front-loaded rate hikes. So many central banks, and or maybe in particular the Riksbank, we have argued that we are choosing a front-loaded approach. We have, so recently we raised the policy rate by 50 basis points. Normally we move in steps of 25 basis points. And, but 50 basis points has almost become the new norm, and some central banks, major central banks have raised the rate by 75 or 100 basis points, and some of the smaller central banks have raised by even more. But even those that raised by more than 50 basis points, the communication, the market pricing, etc., indicates that there will be more rate hikes to come. So the approach is still gradual, and it's very explicit from the Riksbank, because we publish a forecast for our own policy rate, the path that you see here to the right, and it's clear that we have a plan to continue raising the policy rate. So we have argued that it's important to act quickly, but we still plan to act gradually. So what are the arguments for moving gradually or taking really big steps? And if we know roughly where we want to be, say, a year from now, why don't we move all the way or almost all the way immediately? So by gradual, I think this is well known, and we have a gut feeling that this is the right approach normally. There was actually a research literature about this in the, say, late 1990s, but I haven't seen much afterwards. And there is an analogy that is sometimes used. It's like driving a car with a very dirty windscreen. So we don't really see where we are heading, and we have to be a little bit careful. Maybe we look out the side window, try to interpret current data, or look in the rear mirror, interpreting where we come from, trying to figure out where we are heading, etc. There's a lot of uncertainty, so it's a good idea not to do too much and generate volatility. Maybe it's bad for reputation if we have to take a step backwards, etc. Possibly. So I think those are the arguments that can be used. But on the other hand, there are also arguments for sometimes being more aggressive, and possibly today is such a situation. The wind screen is maybe not that dirty. We know inflation is very high, that we have an inflation problem. There are scenarios where we get really bad outcomes, where we start to lose credibility for the inflation target, and we really want to avoid being close to those scenarios. So we want to steer away from that as quickly as possible. And that is basically how we have argued from the Riksbank side. So this is a quote from our most recent monetary policy report, basically saying it's better to do a lot now than we don't have to do as much in the future. What I wonder is, what does this mean in practice? How much should we do? Have we really done enough? Are the steps we are taking sufficiently large, given how rapidly the world has changed in the last year or in the last 2 quarters, basically? So that was the first point that I wanted to raise. The other one, I will be a bit quicker here, is about funding of central banks. And there are 2 parts to this. One part is a structural part. So what you see here is the Riksbank's balance sheet. To the left, the 2 left bars is the balance sheet before the global financial crisis. A very conservative, minimalistic balance sheet. It was decided by the liability side, basically. We had accumulated some capital, the net worth part. There was a demand for banknotes in Sweden still. And from this, we could generate a safe return by holding some assets, say US treasuries with a 4% interest rate or something like that. That could fund our own expenses, and we could transfer money back to the government, our profits after expenses, etc. There are structural changes, structural challenges to this model. In Sweden, it's very visible because there is no demand for banknotes, so seniorage is disappearing. And with low interest rates, we don't really get the 4% return on the assets anymore. But then obviously there has been a lot of activity with balance sheets from central banks. You see a dramatic change in the Riksbank's balance sheet. we have done very little in comparison to other central banks and relative to the size of our economies. But today there's a lot of interest rate risk on our balance sheets, and when we raise the policy rate, we make losses, rather substantial losses. So net worth is quickly disappearing, and there will not be remittances rather likely to the government, etc. So I have a number of questions related to this. I will not mention all of them, but how will this affect the perception of a central bank if we don't return profits to the government anymore? If we cannot fund our own activities, of course we can always print money, but in some sense we lose control over monetary policy in such a scenario. How should we then be funded? Should we be funded as other government agencies, or are there other models for how a central bank should be funded? So just one thing that I want to mention here is that this also relates to the transmission mechanism for QE. One of the arguments for why does QE work is that it commits the central banks not to raise policy rates because they would make losses and they want to avoid doing this. To me, it's clear that in the Riksbank, that is not an issue, and I haven't heard any other central bank actually communicating like that either. So I'm pretty sure that central banks will not refrain from raising policy rates just because they will make losses. So we will raise policy rates as necessary. It may lead to substantial losses and no remittances to our governments, etc. So that's the question I want to talk about, really. But possibly also, what does that mean for when we design QE programs? Then we consider the financial risks that QE implies, etc. So maybe it has implications for how much QE we want to do when we don't have a crisis, etc. So I think I will stop there. My time is, well, basically up. So thank you.
Thank you. Thank you very much, Martin. And Diogo Guillen is next.
Thank you. Thanks, Jordi. Thanks, the panelists. And thank you for inviting me to the conference. The tracks and the papers seem really good. I'm happy to be here. So my focus here will be less on the outlook or on Brazilian monetary policy and more on some of the challenges on price dynamics that I see. So it's going to be more about questions than answers. And I would pose two questions here. One is, how unique is everything that we're seeing? And if it's unique, the standard analysis is fitted or not? And the second one, how much of it is a structural shift? So there were many things that were happening before the pandemics, but how did pandemics really change these structural things? And so let me exemplify a little bit based on these two questions that I've raised. So from where we are on the background, I think there were two main aspects that help us understand where we are. One is a shock on the matches, and it's not only the mismatch on the firm side, but a mismatch on the households, that they could not find where to offer labor supply, or they could not find the goods that they wanted to buy, but also on the firms, say on the suppliers, if the firms could find suppliers or if the firms could find clients. And I guess the question is, if this is the shock, this matching shock, what happens when you unfreeze the economy, right? The economy was frozen, and what happens when it unfreezes? And most of the models really don't deal with this type of shock in the aggregate. And the second part of what is going on these days, I guess, it's how it's going to be the counter-cyclical policies. Maybe it was a bit unique on the scope or on the size to have fiscal, monetary, prudential policies correlated across countries, within countries, and on the size. But now, I guess, it's a bit of a reversal of these policies. So going on from this background, trying to understand a bit the price dynamics, I would just split into the goods prices and services prices. I think there's more emphasis on goods prices these days. It has surprised on the upside persistently. And people have talked a lot about the supply, right? Bottlenecks, the whole problem of chips, energy. And I guess the question is how much it has really changed and going back to the question if it's a structural shift. There was part of it that it was a structural shift before, say on energy, but maybe another change is the policies that are being affected and are changing once you have a change on these goods prices. And I'm talking here, for instance, deglobalization. So it's not really the shock itself, but the policy that came with it. And still on the goods prices, the other part would be the demand side. I think the demand is a bit more of the usual aspect, right? We have the intertemporal consumption smoothing. So there was a counter-cyclical policy. You put money in the economy, consumption increases, and so on. And intratemporal too. Households could not go to services. They increased the expenditure on goods. So there is a bit of both. I would just add a third one, and it's more of a speculative one, and based on anecdotal evidence. So we usually think of this price setting being, say time dependent, but maybe during this process that we had all the bottlenecks, suppose that prices were set in match specific terms. And then you have your supplier, you don't find your supplier anymore, then you have to set a new contract. Once you have to set a new contract, it's the time to change prices too. So it would be sort of increasing the probability of changing prices at some point when you start changing your supply chain. And I think all these 3 points are quite important to try to think how it's going to be the persistence of the shock and how monetary policy should react to it. Finally, on services prices, and I think it's a bit of the usual uncertainty that we usually deal with. I think it's more about the decomposition. Think of a Phillips curve. I think it's more of a decomposition of what is pushing inflation higher on services. One aspect would be markup shocks, for instance, that nobody was leaving home and then people wanted to go out, and then you have an increase on the bargaining power of, for instance, a bar offering a beer. But I think there is always an uncertainty on the output gap, and maybe it's even higher these days. The uncertainty on getting the right output gap when you have the filters are changing at the margin. Also, how to measure productivity after the pandemic. So it's tough to get a good estimate on the slack. And finally, on the Phillips curve, I would say just the expectations. And I think the literature has been addressing a lot these aspects on expectations. And many of these dimensions we are seeing that they are really relevant, say. So for instance, the biases, if you are talking about household service, firm services, market professionals, or if we're talking about salient prices, or if it's in attention, I think all these dimensions that the literature has been bringing, I think they are even starker now. So just to finish off these aspects that I've mentioned, I think it's a world with a lot of uncertainty. There's a lot of uncertainty on the assumptions that we put in a model. So just to give one example, oil that we usually put as an assumption, what it's going to be the impact of oil prices on inflation. There's also uncertainty on the parameters of the model, on the shocks or on the parameters, what is the dynamics, trying to understand it. And obviously the uncertainty on the future shocks on the environment. And I guess here at this conference, I'm happy to hear and learn a bit on this uncertainty on these parameters, on trying to understand the economy and the models and how to react to it. Thanks.
Well, thank you very much, Diogo. And Philip Lane, the floor is yours.
Okay. Good afternoon. So let me thank the organizers. Let me especially acknowledge actually the important role of Raphael in having really driven CEBRA over recent years. And I've had some insight into the kind of efforts of individuals, in particular Raphael. You know, this real collective public good in having CEBRA as a link across the central banking community and between the central banking world and the academic world. So it's very nice to see so many people here today from central banks and from academia, and also in a great location here at Pompeu, Fabra. Okay, so let me turn and give us some kind of overview in a few minutes. Now, I did write out some text, which you can find on the ECB website, but I'm not going to try and just read word for word here. So I'll give you some flavour in these remarks, but you can if you want to, read the more kind of detailed note later on. So, as one reason why I was pleased to have this opportunity today to speak is it's really the start of a new period. Of course, the start of a new academic year around the world. We've been away to reflect on over the last number of weeks, but it actually turns out to be an important new regime, I think, at the ECB and for many central banks. So the last 6 months, broadly from December to July, was essentially, if you like, a progressive move away from lower band monetary policy. So, the step number one was in December was deciding that we would end the PEP program in March. Then early this year, we progressively curtailed the net purchasing under the APP and eventually ended net purchases just at the turn of the second quarter to the third quarter. And then, of course, in July, we stepped out of negative rates. So what we have now going into next week's meeting is essentially a more normal setting. Still not totally normal because it's still a pretty big balance sheet lurking in the background, but essentially where we have to think about, well, how do we set interest rates in this world? And another element of this is essentially also move away from interest rate forward guidance towards a meeting-by-meeting approach. Now, again, this is something that was always going to happen as part of our strategy review, which is, forward guidance primarily was motivated by the fact that when you're at the lower bound, providing guidance about future rates as well as the next interest rate decision can be helpful in boosting monetary accommodation. But actually, when you move away from the lower bound, then forward guidance as such in terms of quasi-commitments to future interest rate decisions becomes less useful compared to the flexibility of a meeting-by-meeting approach. So then it's worth thinking again, going back to pre-2015 or even longer, and say, okay, what does a meeting-by-meeting approach mean? And the way I wrote it in the note is essentially that there's really two analytical steps. One is working out what is the conditional path for policy rates that will make sure inflation returns to 2% in a timely manner. And I guess that's more formally set up in the way the Riksbank organizes itself, and you saw it in Martin's graph. So there's that. And in the market chatter, this is often essentially collapsed into a version, okay, what's the terminal rate? Where are you headed? Now, again, when I say terminal rate in that context, I mean within the projection horizon. I don't mean where rates might be 10 years from now or, in the indefinite future. It's at the end of the current projection horizon, if you like. So then that becomes an interesting question because in the long run steady state, of course, we think about R star, you add 2% inflation and you get the steady state nominal interest rate. But of course, if we think about the next couple of years, we're not necessarily going to be in that long run steady state. We may have cyclical forces in either direction, cyclical forces that say that the policy rate should be above the neutral rate. We may have cyclical forces that may say the policy rate should be below that rate. And so that is kind of the primary analytical challenge is, and that's how we would set up the analysis, okay, what is the interest rate path we think we need to get back to 2%? Then the second part of the question, which is what Martin has taken on, is let's say you've identified where you need to go in a conditional expectation sense. How much do you do in any given meeting? Do you go all the way in one shot to that rate? or is there a case for having a kind of multi-step approach to that? So let me come back to that in a second. So in the first part, which I think is most of the analysis, because that's really a tactical issue, mostly. How do you chop up the adjustment into individual meetings? The big analytical issue, okay, what is the path for the interest rate you need to bring inflation to target? So let me identify the two opposing forces which are something that all central banks, but definitely the ECB, has to deal with. Now, one is for sure, absolutely, the inflation rate now is high. It's extremely high compared to the target. And that kind of cyclical distance, even if you're fully confident over time inflation will return to 2%, there is essentially an adjustment phase there, which is a lot of this inflation has been unexpected. In particular, many people's wages are not aligned with the most recent price level, to put it mildly. Many individual firms may also have prices they charge which is out of line with the input costs they now face. So even adjusting to the inflation that's already happened, there's still some distance to go in that adjustment. And that is going to keep inflation high for a significant time to come. And of course, from a policy point of view, we cannot be indifferent to that, because the longer inflation is high compared to 2%, the greater the risk that it becomes embedded. It no longer becomes an adjustment to a shock. It becomes a self-sustaining shift in expectations, and the whole economy shifts towards that. So that would call on its own terms for having an interest rate high enough to make sure that that dynamic does not take hold. In the other direction, of course, we absolutely face many indications of an economic slowdown. So the fact that we have a major terms of trade shock, the fact that real incomes are falling because of the increase in energy costs, the uncertainty associated with the nature of this shock and with the war. There's a list there of reasons to believe the economy is going to slow down. And the slowdown on its own is going to be disinflationary on its own. So this is essentially going to be the kind of issue for us, is balancing those cyclical considerations. Now, at the same time, of course, where we are now, where the policy rate is 0, is below any version of the terminal rate. So we said in July, and it's fairly obvious, and the market believes that the surveys anticipated, is there will be a series of hikes coming up. But of course, what the big debate is exactly how high should the accumulated increase be, and how we should chop it up across meetings. Let me say about two reasons that in the end, what I say in the note is essentially a two-handed approach to this. It remains the case, a lot of the logic to gradualism remains there. A very big one, which is a kind of practical monetary policy issue, is we should be humble about how the markets and the financial system responds to large rate increases. So if you're going to deliver the same amount of cumulative hiking in a given window, I think you would learn more, and you can also make midstream corrections if you chop that up into individual adjustments. I would say, of course, that doesn't mean you pick the smallest possible increment. The greater the distance from inflation today to the target, it's clear then the kind of basic increment in that adjustment should be bigger than historical norms. But the other factor is we should also recognise uncertainty is not all in one direction. There is a skew. There's more upside risk to inflation than downside right now. But there could be reversals on many dimensions where the terminal rate is not always going to be revised upwards. The terminal rate may sometimes be revised downwards. And so if you move in kind of smaller increments, it does allow you to make that kind of midstream correction. Let me maybe, in terms of the time, because say a little bit about how we think about inflation expectations, because absolutely the anchor of keeping long-term expectations stable is so important. And as of now, across all of the different measures we look at, the market, expert surveys of different types, and also the consumer surveys, let me make 2 points here. One is we should not only look at inflation expectations, but also other expectations, because understanding how the economy will respond to inflation expectations, it does depend on what people believe about their own future prospects, what they believe about the future of the economy, and so on. Because clearly, the most pro-cyclical dynamic is a situation where we expect inflation to be high and you expect the economy to be overheating. Whereas if you expect inflation to be higher than normal, we also expect it to be a major economic slowdown. The kind of pro-cyclical dynamics from the real interest rate channel are going to be less powerful than in a demand-driven overheating boom. But what I would say is across all of these things, broadly speaking, there is a negative slope. Near-term, medium-term expectations are well above long-term expectations. And maybe the interesting debate about long-term expectations are two. There has been an upward revision in the consumer survey, but there's very big literature about how to interpret that. But what's very interesting is this right tail issue, which Ricardo Rice has highlighted, which is, okay, maybe the modal answer still is around 2%, but there's more people answering above 2.5%, let's say. And what's interesting here is really there's two ways to think about this. One is in a world where many people are inattentive, those who are revising their expectations to the right are the attentive people who basically are alert. And under that circumstance, it may be a leading indicator for more general revision expectations. And of course, this is part of the 1970 story. It turned out to be a permanent increase in inflation. And those who were early to anticipate that proved to be correct. But that is one episode. You can also look at a lot of behavioral economics literature which focuses on overreaction, people extrapolating too much from current data to future data. So if it turns out this time, which is in line with other indicators, this shock in the end has a big temporary component, those who overreacted now will turn out not to be a leading indicator of what's to come more generally. So, the right tail issue, it does it on its own terms. It still, in the end, boils down to how much of this is temporary, how much of this is permanent. But of course, a lot of that turns on, okay, how forceful will central banks be in making sure, indeed, the return to 2% is appropriately timely. So let me stop there. It's a bit more detailed in the written note, but you can read that whenever you get a chance. Thank you.
Thank you very much, Philip, and thanks to the three of you for such insightful comments. So let's turn the floor to the audience. So please, if you have a question, raise your hand, and there will be a mic that will be passed around. Please. So, question here. Let's collect 3 or 4 questions. Okay. Go ahead.
Okay, hi, my name is Kang Han-gu from the Bank of Korea. Thank you for your valuable presentations, important insights. My question is about the fundamental cause of this kind of high inflation, the return of inflation. If we think of the early stage of the COVID-19, then we can understand that this current inflation is basically caused by the COVID-19 occurrence, which we didn't have from the World War II. It's a kind of new ecological disaster. So, so we, central bankers, wanted to deal with the COVID-19 with the unconventional monetary policy, and government officials used the massive fiscal support. And then we have this current situation. So, and from now on, we can have another kind of COVID-type disease in the long run, and that can be a recurring situation. Then what do you think of our best strategy as a central banker or government officials regarding the recurring ecological disaster? Should we repeat the process of the last year or this year, or any other options that we can take in the long term?
Okay.
Thank you.
Thank you. There's another question. There at the end. Please raise your hand. Thank you. Please keep your questions brief as much as possible. Thank you.
Hi, I'm Christina Mana. I'm from the Deutsche Bundesbank, so the Central Bank of Germany. I would have a remark regarding the pace of tightening in different countries around the world. What if this pace of tightening might be influenced by financial stability risks? So what if in certain countries you can tighten far faster without posing financial stability risks than in other countries? That would be one question. And the one for central bank independence, even if we are in a cashless world, what if we had required reserves which are not remunerated? Because still the central bank is providing a service to the economy. It's managing the unit of account, and it is stabilizing it in the face of business cycle fluctuations. Yeah, thank you.
Thank you. Please.
I'm Roger Cesabianchi from the Bank of England. I have a question on, for the panelists on what their thoughts are about the behavior and the future evolution of the equilibrium real interest rate. So my starting point is that we thought the equilibrium, this object that is unobserved, of course, was low, and it's been low for, or declining for many years. The question is really abstracting from the cyclical influences that we're seeing now. Would the panelists see the real equilibrium real interest rates fall back as we had in the last few years, or maybe increase, and if so, what are the reasons behind it? Thank you.
One final question for this first round here.
Hi, thank you for your presentations. I just have one question regarding this discussion about front loading. I guess, I don't know if we should call it front loading in the sense that really it's catching up maybe with inflation and inflation expectations, because if we look at real interest rates, they were decreasing with increasing inflation and inflation expectations. So maybe, I don't know, what are your thoughts on this? Because, for example, in the case of Latin America, Brazil, Mexico, and other countries, starting since last year to hike interest rates, maybe not having the luxury of wait and see, but I would like to hear your thoughts on this.
Thank you. So why don't we just go around the table and feel free to address whatever questions you want. Do you want to start, Martin?
Yes, well, thanks for all the questions. So I'll try to answer a few of them at least. The front loading and the speed of adjustment, etc., financial stability risks, etc. So yes, I think that in practice has mattered and will continue to matter for how central banks respond to what we've seen. So interest rates have been super low for such a long time period, and we don't really know how the market, by the market I mean financial markets, households, etc., will respond. And clearly in Sweden, the public finances are in good order, but households and some businesses have accumulated much more debt over the last decades than before. So that's something that we are following closely, and I think has affected how we respond. So that is one such thing. The other point about front-loading is that are we really front-loading or are we just catching up? I kind of agree. That was the type of discussion that I wanted to have. The world has changed dramatically. So inflation is so much higher today, and inflation forecasts also. On the other hand, as Philip was saying, inflation expectations have been rather well behaved so far. So in that sense, I think we are not catching up. We still have a lot of credibility for what we are doing, and anticipations are that we will manage. But it requires that we continue to respond in the right way. About funding of central banks, yes, required reserves could be one possibility. It is actually to give central banks some taxation power. So you can debate whether an independent central bank should have such powers. The Riksbank, for example, we can impose required reserves. We don't do it, but we can only do it for monetary policy reasons. We cannot do it to fund our own activity. So I guess legislations will vary from central bank to central bank. But what I want to have is really a discussion about what should the legislations look like, and should this be a tool, a way of funding central banks, or is that not democratic? Should they be funded directly through the governments, and will that matter for policy independence, etc.? I don't have the answers, but that's one of the things that should be discussed, I think. So I'll stop there for a moment at least.
Diogo, you may want to go. Also, feel free to comment on each other's earlier remarks. I forgot to give you some time for that, but please take advantage of this time to address any comments that your fellow panelists have made before.
Do you want to add, or?
You want?
Okay. So let me, I guess, on this question of front-loading and or going aggressive. Some of the arguments that have been put were based on being cautious, right? The old literature on saying that you shouldn't hike as much because of maybe you want to buy time, maybe you want to learn a bit of the uncertainty that is evolving and you don't want to hike too much. The second one would be on, and I guess this part I take the point, but when you know that the cycle will be a large one, this decreases a little bit this factor. The second one would be a bit on the volatility, how the market will behave. And I would just add, because it feels to me that part of the discussion is more about the options of a given meeting than the path itself. So whether it's going to be 50 or 75 or 25 or 50, something like that. But it feels more, it feels that it's more important thinking about the front loading in the path itself, hiking more now to hike less later, and how the market will react to that. Monetary policy has lags. So if you front load it, probably you would stop hiking when you don't see yet the full impacts of monetary policy. So how would the market react to these aspects? So it's a bit more on the path than on the meeting itself. And also I want to take the point of Philip on the expected inflation, right? I think we're on the inflation forecast market implied to households, market professionals. I think we are learning a lot about, say, the tails, as I mentioned, or which one is a leading indicator, or which indicators should we look at, or how to bundle all of them. I think these are great points that he put.
So I mean, what's happened in the last few years, of course, will keep a lot of people in this room and elsewhere very busy for a long time. So it's the opening question about the fundamental drivers is a super interesting question. But I mean, I think last year, I mean, definitely last autumn, there was a kind of clear focus on a lot of pandemic issues. So the kind of rotation into goods, rotation out of goods towards services, the implications of shutting down parts of the economy versus other parts of the economy, the bottlenecks which then feed into supply chains. And now this year we've had another stage of that with the reopening of the economy, and that in itself causing new issues. But by and large, my conjecture is that's going to turn out to be significant, but not the dominant, at least in the current context, in the European context. You know, the dominant issue is what's happened in the energy market. You know, basically over the last, since the bottom, now there was, you know, rather than go back to the fact there was some fall in 2020, but it's now such a gigantic increase in the price of energy. And then the question, you know, do we think that's because of easy macro policy? Do we think it's because of other factors, supply factors, the long-run issue about the transition away from fossil fuels, where gas plays an important transition role? And of course, you know, first and foremost this year, the implications of the war and geopolitics. And then when you kind of boil it down to, okay, what is the macroeconomics of a massive energy shock? I mean, to me, this is now the most important way to frame what's going on. I think that there's no contest on that. Whereas, you know, we are seeing the bottlenecks easing. You know, not as quickly as we would like, but they are easing. The reopening is more or less over now. So I think, you know, that dynamic is coming out. You know, I don't think it's a bit early to write the full history of that. Let me go back. I mean, I referred to in passing, but one of you asked this question about. I mean, it's very interesting, especially trying to kind of analyze Taylor rules and so on. Is when you do have this issue now where yield curves have steepened because policy rates have only moved so much. But if you look at 1 year ahead rates, 2 year ahead rates, they've moved quite a bit. And then the question is, say, well, you know, if you think a minimal condition is you should be responding to an increase in inflation with you know, the Taylor principle of you know, interest rates going up by more. If you look at rates 2 years ahead, 3 years ahead, although in real terms they've gone up. So compared to the super low rates we had, those rates are a lot higher because if you like, you might have 150 basis points, 200 basis points increase in the nominal rate. But, you know, before you know, a year ago, our kind of 2 year ahead inflation expectation was, let's say, 1.6. Now it's low twos. So you have a 60 basis points maybe increase in expected inflation. You have north of 150 basis point increase in the nominal rate. So there is a significant increase in real interest rates at longer horizons. What is true is you think about the interest rate that's relevant for like a 1 year ahead transaction. Okay, maybe the adjustment there is, but that goes back to my other point about macro expectations. In a world where there's a lot of pessimism about the next year, you know, the consequences of having, you know, a short-term interest rate in real terms that might be a bit low is not the same as we had in Europe in different countries in mid-2000s, where you had high inflation plus an overheating economy, and there you had the classic kind of Walter critique of a pro-cyclical real interest rate channel. I'm not so sure that that is so important in the behaviour right now. We are not seeing huge increases in demand in the European situation. So let me, for now, pause there.
Thank you. Let's collect a few more questions. Luca.
Hi, Luca Fornaro from Craig. My question is about the exchange rate, whether you're attaching a higher weight on the exchange rate now compared to the past, and the risk that an exchange rate depreciation might lead to imported inflation. And if so, whether you see scope or need for monetary policy cooperation across different central banks?
Thank you. Thank you. So during Jackson Hole, the BIS General Manager Agustin Carstens gave a speech that highlighted how going forward there would be a limit for the demand-side policies, and then there should be more of a focus on commitment to revitalizing the aggregate supply and productivity growth. So during the pandemic, central banks innovated into different types of policies and different types of roles. So going forward and in practice and more in emerging markets, what type of policies could central banks then implement to revitalize aggregate supply and help regain productivity growth? And the question is, even should central banks really meddle into that space?
Can you hear me? Yes. So my question goes back a little bit to the first question. So what are the tools and what is the kind of data that we should be doing research on, trying to collect now that you wish you would have had in the last 2 years? And because this might come in handy as we go forwards, what are the models? Do we need more real-time, longer horizon expectations, like Philip just said?
Stop here and start a new round of answers. Do you want to start, Philip, now, just to change the order?
Okay. Those are good questions. I mean, it's motherhood and apple pie. Under all scenarios, that faster, sustainable growth rates are a good idea. So I fully sign up to that under all scenarios. But I don't think it's for central banks beyond making sure prices are supported by being stable. The research question is a very good question, Raphael. So let me say 2 areas which, one, and you said it in your remarks, which is when you have a big enough shock, do some of the adjustment mechanisms basically flip? So there's move from kind of gradual price adjustment to state-dependent price adjustment. That there's essentially, if you conclude there's a persistent supply shock, the scale of the pass-through might be a lot bigger than if you're saying, well, I'll make a partial adjustment because maybe the oil increase will reverse itself 6 months from now. And so there's lots of things there which, if you're locked into saying, well, the average response to such and such a shock is X, thinking harder about, okay, under what circumstances should we look at, and all the economic models are there. There's tons of models out there which would have pointed at. It's a question of selecting at a particular point in time, what is the model you want to use? Because, I mean, I've gone back and I've found, for most things I've had a question about, I have found over, maybe I have to go back 25 years sometimes, but you can find the basic idea has been. So I think a lot of it, first, is model selection as opposed to some entirely new way of thinking about the world. The other thing I would say is global modeling. So honestly, going back to supply and demand issues, probably what collectively a lot of us missed was we can see in early 2021 with the extra fiscal action in the US, we would, I'm sure everyone was saying, okay, what's the spillover to us of the extra fiscal injection in the US? But, we would have had estimates of the ECB, I'm sure everyone had estimates. But globally, understanding what happened in goods markets, especially in 2021, where there was a much faster recovery in demand than, and any individual country may not have had enough insight into that. Let me go back to the earlier question about R-star. Futurism. I mean, there's a kind of, you can be futuristic and say, I have a strong view about demographics. I have a strong view about the possibilities of AI or something boosting the growth rate of the economy. Honestly, I mean, I'm going to take the view that R-star moves, from my projection horizon next couple of years, moves so slowly that I'm not going to spend a huge amount of time about R-star. But what I was trying to say today was that is not the main issue over when you think about monetary policy over a 2 or 3 year horizon. The fraction of the variation in policy rates that, over that horizon that should reflect changes in R-star is probably pretty small. it's going to be the cyclical assessment, not the long-run steady state assessment. Now, if you say over a 10-year horizon, it's super important. But over a 2 or 3 year horizon, I would say cyclical factors will dominate that kind of trend factor.
On the neutral rates, I'm with Philip. I think it's more of a story of cyclical rates than the R-star thinking today. So how far you wanna be from this neutral rate, and I think Brazil is a start to show how far you can be from the neutral rate. In our inflation report, we have raised the neutral rate in, say, last 2 months, but it's a tough time to have a very good interpretation of structural parameters, right? When the economy is still evolving and coming back from the pandemic, so it gives you more confidence on the cyclical aspects than on the structural ones. Now, on the what we could have had on research or on models that was asked, I guess one aspect is a bit of the supply side. I still think like that, say networks or supply chains. I think the persistence of the shock of these bottlenecks was higher than many expected, and I think we were learning through time about this. And the other one, I think it was a bit already exposed, the whole discussion on inattention. How do we deal with people that are inattentive? How are their expectations being formed or attentive, or how does it change the state dependence, right? When do people get attentive or not? How do price changes state dependently when you have a high inflation? I think in the end, it's really, are these parameters really structural or deep, or they are state dependent, and the model changes a little bit during these times?
Yes, so if I start with what Diogo just said, and that was really something that you talked about initially, also about the match-specific relationships that are being broken up with supply chains, etc. Is that important? And maybe it is. But I'm thinking, and going back to the question about the fundamental causes of the inflation that we're seeing now, I agree a lot with what Philip said. But I think there is also an important element here of non-linearities when we combine all these developments and the magnitude of the shocks that we've seen. So it's been these bottlenecks, and for a long time in Sweden, and I think many places in Europe, we saw that there were bottlenecks, producer prices increasing, there were shortages and high demand. There was, of course, the policy was stimulating both monetary and fiscal, but firms didn't raise prices. And we asked businesses in Sweden, how do you set prices? What are your plans? And why don't you raise prices in this environment? And they said, well, it's impossible. Customers don't accept it. But eventually, in some sectors now, with the enormous increases in energy prices in particular, so this came basically after the war, it was impossible you had to raise prices. And then the mood totally changed. And in the more recent rounds of the business survey, firms said, well, it's so easy to raise prices. No one is surprised. No one is complaining. They are anticipating rapid price increases. So it is a non-linearity, I think, that was really the top of everything that changed the dynamics a little bit here. And so far, it hasn't really changed expectations that much. So it's maybe a one-time adjustment, and that's what we have to end up with. So that was on that part. The other more recent questions, what tools and data do we need? So one topic that I've been very interested in myself and done some research on is the cash flow channel of monetary policy. And I think here so we have so rapid changes in cash flows today. So it's an excellent opportunity to try to examine precisely which households are affected, how much we see very big changes in cash flows, and how do they respond in terms of consumption, etc. So we need good data here, detailed data on wealth, debt, and consumption. And we have, so I think there has been a relatively good development with more and more microdata. In Sweden, we had some political decisions like 15 years ago that we stopped collecting detailed wealth data, very unfortunate. But then more recently, so we got some new databases, and I think probably similar developments in other European countries. GDPR has actually stopped. So some of the things that we did before GDPR, we cannot do anymore. So we are not getting better data anymore, microdata on these variables. We need it. It's important for us to understand how monetary policy works. So no one, I think, responded to the exchange rate question. Clearly, exchange rates are important, in particular in the smaller economies. So Sweden is very exposed to the exchange rate, but it's not a top priority, and it's not a target. It's one of the things that can affect inflation. So inflation is what we focus on, and to focus on that and understand inflation, the exchange rate is one of the elements. The krona is weak. It doesn't help us currently, but it's not something that we are specifically targeting with our policies.
Thank you. We're almost out of time, but I would like to use my privilege as a chairman to ask one final question, if you allow me to. And it's one on a topic that I have to admit keeps me awake at night. The circumstances have been such in the macro environment over the past maybe 3 decades that, by luck, I guess, central banks, at least in advanced economies, maybe not so much in emerging economies, have never had to take a very clear, strong, pro-cyclical stance. In particular, there has been not a clear instance in which, as a result of some non-policy shock, some external shock or whatever, that has in itself some contractionary or leads to contractionary pressures on the economy, the central bank has had to amplify, so to speak, those contractionary pressures by raising interest rates and possibly, as we will see in the next few months or years, raising interest rates very significantly. So how do you think the general public will react to that? Because I think they will understand, because it will be made clear in communications. Chairman Powell, I think, made it clear in his Jackson Hole speech that the Fed reaction will cause some pain to households and firms and so on. So how do you think the general public will react to that? And whether you think this will have consequences for central bank independence in the medium run?
Okay, maybe. Well, for Brazil, I think it's we have seen other periods of high inflation, and I guess the point here is whether the general public will react to a contractionary shock. I think it's about the mandate, right? When you ask the surveys or when you try to understand how the public is looking at the situation, I guess it's more about the high inflation than the shock, the possible contractionary shock. So sticking to the mandate and reaching the target, I think it's the best way of having the public with you during this cycle.
So there's probably going to be maybe some kind of a contrast between the ECB and the Riksbank. The ECB is 22 years old. The Riksbank is 200 and something years old. 300 and something. So there's this is going to be, if you like, because more or less the disinflation in Europe had already happened before '99. So since '99, the ECB has either been more or less adjusting to keep interest rates, inflation more or less around 2%, and then it had to deal with the crisis, had to deal with the low inflation period. Is not had to take on now a kind of disinflation campaign as we now face. So, I think leaping forward at a time machine and looking back, how we handle this, which is just so central to the mandate. I mean, it is price stability. There's no contest here that we do have a major, but we have a very clear mandate. We have a ton of legal independence. I mean, the board of the ECB you know, we're not connected to any national government, much more so than maybe the pressures in a national system. The setup of the ECB was designed to make sure high inflation does not persist, that we do have the operational independence to deliver. And especially when the nature of the shock is so common, you know, it basically will allow, I think, the ECB as a common central bank for, you know, now going to be 20 countries from January 1. I think the ability, you know, I think someone asked about monetary policy coordination. And when we've inbuilt coordination for the euro area because we have a common currency, compared to what, you know, would be the headache if you're trying to disinflate country by country in a 20 country area. So it's going to be, you know, I think a major challenge to kind of deliver this. And again, let me come back to what I emphasized earlier on, is there are two forces here. We have the risk that high inflation takes on its own momentum. On the other hand, we do have significant headwinds for the economy. And, you know, developing the kind of policy path that allows for both risks in terms of how they affect the inflation dynamic is going to be, you know, clearly a major issue for us. And I think you were saying earlier on about what happens when, because monetary policy works with a lag, that inflation has not yet returned to the target, but the policy cycle has reached a certain point. So, you know, we might say, well, we think a lot of what we're doing is going to, over time, disinflate the economy. But so long as the latest inflation reading is high, clearly that's a kind of a major communication issue, to say the least.
But I think I agree to much what has already been said. It will be a challenge, but if we fail in terms of inflation, that would be more problematic. And people in general do not like inflation. And our mandate is very clear. The top priority is to get inflation to around 2%. As the forecasts look today for most economies in Europe, the US, etc., it looks like the real side of the economies will not be a disaster. It will not be a deep recession. But clearly, there's a lot of uncertainty here. And if that's what's necessary with monetary policy, it could happen. And it will be a little bit of a challenge potentially. I think also that we sit a lot in the same boat, all the central banks, or in the same canoe, maybe if I should return to the previous image that I had. There will be spillovers, not only the normal economic spillovers, but also like the reputation and the sentiment towards central banks and inflation targeting, etc. I'm rather optimistic still. I think we are doing relatively fine, and there are good prospects that we will manage here. So we can wait with the most pessimistic scenarios, I think.
Well, I think our time is up. Let's conclude here. Let me thank the three panelists for a great discussion, and the audience also for very interesting questions. And please join me in thanking the panelists.